Hello SD Bullion YouTube subscribers, my name is James Anderson, and this is our first SD Bullion Gold-Silver Market Update. If you are interested in physical precious metals and financial markets, be sure to become a free subscriber to our SD Bullion YouTube channel. Also hit the like button of this video and click the alert bell so you'll be notified next time we publish more videos. The formula for our weekly bullion market update is still obviously in its infancy, and we really want to hear from you out there. Tell us in the comments below what kinds of information and updates which could bring you consistent value. Let's start by digging into major precious metal price action for the past week and look at some of the supposed drivers for why spot prices got so clobbered. The silver spot price fell over $1.30 per troy ounce, closing this week at around $16.87 per ounce. The gold spot price had its worst week in nominal price action since President Donald Trump was shockingly elected in late 2016. That night, the gold price immediately shot up $50 an ounce on the news, only to get hammered down $100 an ounce the very next day for reasons no one has ever been able to explain. This week's gold price is closing around $1,460 per ounce. Well, that's about $55 off of last week's close. The platinum price, still at 100-year lows in terms of value versus gold, fell some $60 this week, closing just over $890 per ounce. Often, recent record-setting short physical supply palladium spot prices dropped over $100 an ounce this week and finishing just below $1,750 per ounce. The gold-silver ratio has climbed again, and it's above 86 ounces of silver to 1 ounce of gold level. The main attribution for all the severe weakness in precious metals prices was the supposed Phase 1 deal for the ongoing US-China trade war. This was not a physically driven price fall, more so a derivative-driven price fall affair. Of course, there was no mention in the supposed Phase 1 trade deal news if China is committing to end their consistent intellectual property theft, one-party political control of their legal system, continued exportation of fentanyl into the USA, non-liberalization of their markets, or if they will ever lower their seemingly ever-existing capital controls anytime soon. So yeah, we and many other onlookers remain skeptics. Financial Twitter, or FinTwit, tweet of the week goes to Sven Henrich at Northman Trader. He states, "Recycle the same headline over and over and over again, and each time markets jump, and each time it means nothing." His tweet goes on to illustrate a handful of supposed China-US trade deal, possibly soon headlines over the past year. And there were 6 in his tweet, but there's been thousands, if not tens of thousands of them, last 12 months or more, which algorithmic trading machines read and buy on positive news headlines, which help to prop the market up further. Real fundamental substance to those headlines to date, though, really all that's mounted has been tariffs and escalations in respective rhetoric between the two feuding nations. This week, the Federal Reserve added more not QE4 to its expanding balance sheet, as overnight loans to the global banking system continue around 100 billion fiat Fed notes per evening. Only a couple of weeks ago, best-selling author and a vocal proponent of prudent gold and silver bullion investing positioning, Mr. Jim Rickards, was on MoneyWise YouTube channel, and this is what he had to say about the ongoing, unspoken reasons for what may be happening deep within the bowels of the global financial system. Have a listen.
You don't have to go that far to say, well, maybe we'll just have a good old-fashioned financial crisis. Honestly, Rachel, we may be in one right now as we speak. Someone asked me, when's the next crisis coming? I said, well, we may be in one. The repo problems in the U.S. financial system, where the Fed, so from 2008 to 2014, we had quantitative easing. Then there was a sideways period. Then beginning in 2017, the Fed initiated what they call quantitative tightening, actually reducing the money supply. I still run into people, they bang the table, I hate QE, you're printing money. I said, no, that's been over for about 5 years. They're now burning money, throwing money into the furnace to reduce the money supply. Except, just a few days ago, they slammed on the brakes on that and flipped to quantitative easing. The Fed is in the process, as we speak, of printing $1 trillion. They call it system repo, but it's QE4 in all but name. Why are they printing $1 trillion when they were trying to reduce the balance sheet? They were trying to tighten the money supply, and they're printing $1 trillion. Somebody's broke, and I'm not going to mention names, I'm not going to speculate, but they're giving the money to the banks, taking treasuries as collateral, but they expect the banks to lend the money to non-bank players, hedge funds, private equity funds, smaller banks, Chinese banks, etc., and take treasury securities as collateral. And the way it works is I give you $100 million and you give me $102 million of treasury notes or gilts. And so I've got 2% collateral. So if you don't pay me back, I sell the notes in the market and pay myself back. What does this say when the banks are hoarding the money and they won't lend it out and take treasuries as collateral? What it says is that they're anticipating a liquidity crisis that's so bad that they will not be able to sell treasuries at anywhere near the value they got. That's a pretty scary thought. That means they're seeing something the rest of us are not seeing. Now, I won't go further than that because there's no evidence, but just what we know about reserves being drawn down, now suddenly increased, the bank's not on lending, et cetera. Someone's in distress. It could be contained. It could go away. But if it hits and spreads, we could be back in a global liquidity crisis, and it could be starting now.
We suggest everyone take the long view in regards to this recent precious metal spot price weakness. Consider even this technical overall rising bull shape for gold price action, as we will again likely be retesting new nominal price highs for gold early next decade. If you're building a prudent physical precious metals bullion position, consider this past week's pullback and price consolidations as a great gift for new additions to your bullion stack. That's all for this week's SD Bullion Gold Silver Market Update. Be sure to hit the like button, subscribe to our channel, and click the alert bell too. And give us some comments below. I want to hear, and we would like to hear, what you want to see in these weekly updates to come. I'm James Anderson of SD Bullion. Thanks for watching.